For millions of middle-class Americans hoping to buy a home this spring, the monthly cost of borrowing has increased. On a typical median-priced home, the mortgage payment rose by about $17 compared to just last week. That extra amount adds to the pressure many families already feel from groceries, gas, and other living expenses. This week, the 30-year fixed-rate mortgage averaged 6.46%. The figure comes from Freddie Mac's primary mortgage survey released on April 2, 2026. It represents an increase of 8 basis points from the previous week's average of 6.38% and marks the fifth straight week of rises. The rate now stands at its highest level in nearly 7 months. The 15-year fixed-rate mortgage also moved higher, reaching 5.77%, up 2 basis points from the week before. During the same week a year ago, the 30-year rate stood at 6.64%, while this week's average remains slightly below last year's level. The recent upward movement has reversed some of the gradual relief that buyers had begun to experience. Freddie Mac chief economist Sam Khater addressed the timing in the report. He said, "The 30-year fixed-rate mortgage edged up, averaging 6.46% this week. With spring home buying season in full swing, aspiring buyers should remember to shop around for the best mortgage rate, as they can potentially save thousands of dollars by getting multiple quotes." Here is how the numbers translate into real consequences. Consider a median-priced home of $403,450 with a 20% down payment. At this week's rate of 6.46%, the monthly principal and interest payment comes to roughly $2,031. That's $17 more per month than the same loan would have cost last week. $17 a month adds up to more than $200 over the course of a year. For families managing tight budgets, that difference can mean less room for savings, emergency funds, or other necessities. When borrowing costs rise, the same income qualifies for a smaller loan amount. This reduces purchasing power. As a result, some potential buyers step back or delay their plans. Fewer active buyers in the market can slow the pace of sales, which in turn puts indirect pressure on sellers who may need to adjust expectations. Many Americans continue renting because home ownership feels further out of reach. The monthly mortgage payment increase highlights how sensitive the path to buying has become. This latest rise follows 4 previous weekly increases. The pattern shows momentum in one direction over the past month, even as the rate remains modestly lower than it was 12 months ago. Today's buyers would save about $39 per month on the same median-priced home compared to last year. Yet the recent weekly jumps are what many families notice right now, especially during the traditional spring season, when more homes typically come onto the market. The decision to buy a home often ranks among the largest financial commitments a person or family makes. When rates move upward, even modestly, it forces a recalculation. Some households may decide to keep renting longer, adding more demand to the rental market in their area. Others may look for smaller homes, different neighborhoods, or delay their plans. Right now, as of the data released on April 2, 2026, the 30-year fixed mortgage rate stands at 6.46%. The 15-year rate is at 5.77%. These are national averages. Actual rates for individual borrowers can vary based on credit, location, and other factors. For middle-class families across the country, this development adds another element of uncertainty to housing decisions. Many still want the stability that comes with home ownership, but the immediate cost of getting there has ticked higher once again. The housing market continues to reflect these gradual shifts. Buyers are feeling the direct effect through higher monthly payments. Sellers may eventually see slower demand if the upward pressure on rates persists. Renters watching from the sidelines may feel the indirect effects as more people stay in the rental pool longer than they had planned. This is the current reality based on the latest available figures. The numbers show a modest but noticeable increase in borrowing costs at a time when many Americans are carefully weighing their next financial steps. For those in the middle class trying to balance stable jobs with rising everyday expenses, even small changes in mortgage rates can influence where and when they choose to settle down.